Hello everyone, I'm Nigel Catewell and I work in financial education, helping people plan for retirement. I'm here to talk to you about pensions and your retirement. How much thought have you really given to when you want to retire, or even retirement itself? Today we'll be looking at the need to save for retirement. We'll also talk about how much help the state will provide before looking at the government's auto-enrolment scheme and how Police Mutual can help you as well. The UK population is ageing and we're likely to spend a greater proportion of our lives in retirement than our parents and grandparents ever did. How are you gearing up for this? Historically, we've looked to the state to help us, but the bill is growing as we live longer and healthier lives. And this is why the government have taken steps to encourage us to make our own plans. So when would you like to retire? At the moment, the state pension age is 65, but this is about to be increased for both males and females to 66, rising to 68 in the not too distant future. For some of us, it could be even later. Whilst we would love you to be with Police Mutual to celebrate your 70th birthday, is this what you really want? The earliest we can retire and draw any pension benefit that we have built up ourselves is 55 years. But if we want to retire so young, there is a considerable commitment to saving a good proportion of our income for the future. I would ask you to give some thought to when you want to retire and what retirement means to you. After all, it's often said it's the longest holiday we'll ever have. When you put it like that, our dream holiday doesn't come cheap, and neither can they be planned at the very last minute. Your retirement is no different and needs a similar level of thought and planning. So, what are our choices? Well, you could rely on the state. The changes to the state pension that come into effect in April 2016 mean that we will need 35 years of national insurance contributions in order to qualify for a full state pension. That means for anyone reaching state retirement age after April next year, the full pension will be £148.40 each week. However, the amount you get can be higher or lower depending on your national insurance record. It will only be higher if you have over a certain amount of additional state pension. Also, for any of us that don't have the full 35 years of credits, we will only qualify for a proportionate amount of the £148.40 a week. A lot of this you may be unfamiliar with and may have questions about, but I don't want to confuse you with too much additional information at this stage. If you'd like to know more, by all means get in touch or go to www.gov.uk/new state pension. You can also use the FCA's own website, www.moneyadviceservice.org.uk, or their free and impartial advice service, which is available to you by telephoning 0300 500 5000. With all the dreams and aspirations I have for retirement, this will not be enough for me, and you may feel the same. The alternative is to save for the retirement we want. But the overriding question is, how much is it going to cost me? If we look to the Financial Conduct Authority, they suggest that in order to have a pension of half the amount we earn, we would need to save 10% of what we earn at 20, rising to 16% at 30 and 27% at 40. In other countries, this is already the norm, and people think nothing of putting aside up to 10% of their income to provide for the future. Undoubtedly, because we're living longer, in the future we will have to work longer before we get our state pension. Therefore, if we want to retire earlier and have the retirement we dream of, we will have to save more. I believe that this is what the government is trying to get us to do. I do think that a lot of people are put off doing anything because they think it costs too much or they can't afford it. Yet the reality is that it's surprising how much difference a reasonable contribution into a pension arrangement can actually make. If we consider somebody who earns £20,000 a year, with no pension arrangement other than their state pension, after national insurance and tax has been deducted from their income, they will be left with a net monthly amount of £1,379. Because they are paying national insurance, they will hopefully qualify for the full state pension. That will provide them with a monthly income in retirement of £643. The question then is this enough to live on? If it isn't, or we want to retire earlier, then we have to do something. If you decide to do something, you'll not only want your savings to be as effective as possible, but it would be great to get some help as well. As a responsible employer, Police Mutual wants you not only to have enough to live on, but actually have the retirement you dream of. That's why they are prepared to help you, if you're willing to do something and put money aside towards your retirement. I really hope this is the case, because not only are Police Mutual behind you, but also the government want to help you as well. The government has introduced a scheme called auto-enrolment. This means that all eligible employees are automatically enrolled into a qualifying pension arrangement. This is in addition to your state pension. Police Mutual's approach is to contractually enrol all colleagues, irrespective of their automatic enrolment eligibility, into the Police Mutual Group Personal Pension. It does require you to give up some of your income, but Police Mutual will then invest in the scheme with you, and Ian Cordwell will now talk you through the scheme and the benefits.
Police Mutual Group is actually using its own manufactured personal pension product to provide the auto-enrolment solution for you, our colleagues. We've manufactured a product that is able to be done through salary sacrifice, so the payments can be taken directly from your salary, and Police Mutual contributes too. Like most personal pensions, you can take up to 25% as a tax-free lump sum when you retire. You can also access the fund from age 55. This can be different to the age you choose to retire from. And actually the benefits you're able to take are totally separate from your state retirement pension. An additional benefit of this product is that you automatically become a member of Police Mutual. The government set a series of minimum contribution levels that have to be provided by an employer and an employee, and defined those over the next few years. Police Mutual, though, felt that this was not sufficient to actually encourage you to actually save towards your pension, nor would it likely give you the sort of pensions that you might want to have. As a result of which, we've actually set out a table here that shows you the range of contributions that Police Mutual will make. You will note from that table that if you contribute at the maximum, Police Mutual puts in more than you put in, therefore more than doubling the amount that your pension grows as you put in your money. In addition to this, you can, if you wish, make additional contributions. These can be done by direct debit or cheque, as well as the salary sacrifice route for the main element. The money in your personal pension is invested into the main Police Mutual pension fund. Currently, this has the same asset allocation as the life fund and is producing returns that are designed to be smoothed over the cycle of economic growth. It aims to take advantage of stock markets, but it also has other investments in it in order to smooth out the volatility that comes with those equity investments. Technically, it's a unitised pension scheme without guarantees, but it does have that benefit of smoothing, so that if you actually were to retire in one day or the next day, substantially the pot would be almost identical. The government allowed charges on stakeholder pensions to be done at 0.75%. However, we've said we won't take more than 0.6% per annum. Clearly, the fund value will depend upon the performance over the term, and past performance here is clearly no guide to the future. We've set this up so that you can invest in the group personal pension through salary sacrifice. What this means in practice is that you notionally give up part of your salary, and in return, Police Mutual makes that amount as a contribution into the scheme. The advantages of this is that you pay less in national insurance contributions than if you were not in a salary exchange scheme. Effectively, it means that the pension contribution costs you less. It also does not affect your employment benefits. We will instead use a notional salary for calculating all benefits. One point of note, though, is that it may affect state benefits if that's appropriate, as these can be calculated on the reduced salary and national insurance paid. Here's a worked example for someone who's earning £20,000 per annum and has a standard single person's tax code of £10,000 per year. Without the pension, their net pay would be about £1,382. With a maximum pension contribution at 6%, the net pay drops to £1,313, a reduction of £69 per month. However, the total contribution that's gone into their pension scheme is £233. So as you can see, this person has managed to get a pension pot of £233 and it's only cost them £69 to get it. There are obviously many options you have available here, and you will have your own personal circumstances to consider. To assist with this, we have provided a pensions calculator. That calculator gives you the ability to put in various different assumptions and try alternatives. It also then gives you the ability to see what might that sort of pot buy me as an income in retirement.
In the past, I've found that at this stage some people will say, "Oh well, at my age it isn't worth me joining the scheme because I haven't got long enough to build up a realistic amount." And to some extent, that was the case in the past. However, with the changes the government are introducing in April this year, it really is beneficial for almost everyone to save in the scheme. The changes the government are introducing mean you no longer have to use the money you have built up to purchase an income. You may have heard of this as having to buy an annuity. Under the previous rules, with any money that you had built up in your pension fund, you could take 25% as a lump sum, with no tax being deducted, but the remaining 75% had to be used to buy an income for the rest of your life, an annuity. From this April, whilst the 75% is still taxable, you no longer have to buy an annuity with that money, but can do whatever you want instead, any time after your 55th birthday. We hope you'll see that there really is no better time than the present to start building your retirement fund, and that with the changes the government are introducing, whatever your age or length of service, the fact that you're saving, Police Mutual are going to contribute to, and it's also helping reduce your tax and national insurance, then it really makes good financial sense. However, if you decide you don't want to go ahead, you can cancel your membership. And to do this, you should complete the cancellation notice form. Because the government requires us to opt you back in to the scheme every 3 years, you will have to opt out again each time if you're still not ready to start saving for your retirement. By now, I'm sure you're fully committed to the idea of planning for your retirement and can see the benefits of putting some of your money aside. If you really want a great retirement, then remember the importance of doing something and how much harder it becomes the longer we delay. There is always help and guidance available, so please make use of it. For more details, go to Choices.